Hello guys, how are you doing today? It's always a pleasure to have you here. And of course, if you are new to the channel, don't forget to hit the subscribe button. Don't forget to give the video a thumbs up and of course comment in the section below. Today we are going to be talking about what is slippage and how to avoid slippage in the foreign exchange market. Now, as the name implies, slippage, it simply means that something is going to slip. SLIP. Now, what does this mean? As an example, if you set your pending order somewhere, right? You set your pending order, as we have an example here, this pending order to buy. Now, when you set your pending order to buy here, and then it doesn't trigger here, but it triggers somewhere else, it's not a thing of the broker. It's not the broker that is adjusting your pending order entry, right? But rather it is the market. It's what happened in the market. Now, this can occur when we have high impact news. If you look at this candle here, of course you would know that this candle was based on news that came out, and this news was from yesterday's FOMC, right? And of course we're expecting this, and then I gave out the warning, and I decided not to trade. So that means that you must understand slippage, when it might occur, and then how to avoid it. So basically, slippage is when you set a penny order somewhere, it doesn't trigger there, it triggers somewhere else because of the volatility that has been introduced into the market. So this volatility could be based on the news, right? High impact news, or it could even be based on weekend gaps. You know, when we have gaps in the market, right, it's going to show that a space like what we have over here. This was not the weekend, by the way, but because of the volatility that was introduced. Now, when this happens, right, it means that your entry has been shifted, right, because it will now trigger at the best available price in the market, right? I repeat, it will trigger at the best available price in the market. And this is not good because, of course, it could push you somewhere else that will not obviously be favorable to you. Now, when this happens, right, when this occurs, it's best for you to what? It's best for you to stay out of the market, because, of course, you could have heavy losses in this business. You could even have blown accounts, especially if you're not using stop loss, right? Because if you're not using stop loss, you go and then you come back, you now see this kind of candle, this kind of big candle. Of course, you're going to know that something heavy has happened in the market, but then maybe you are not even paying attention to the news. And you know, this could also occur based on breaking news. We have the scheduled news and then the breaking news. That's why it's always good most times to ensure that your stop loss is in place. Very, very important. So how do you avoid this? Simple. When you are aware that there's going to be high impact news like we did yesterday, and I sounded the warning, the best thing for you to do is not to trade. I repeat, the best thing for you to do is not to trade that period, because of course you could have heavy losses, right? You could have heavy losses. Now, even apart from losses, right, you could even have profit that you could make. You could even make more profit. Let me give you a quick example, right? I'm going to explain this based on the advantage and also the disadvantage of slippage. Now let's assume you are already inside the trade. Maybe you entered a buy here, right? And then your take profit was over here on this horizontal line. But then because of the slippage that occurred, because of the volatility that was introduced and the way the market moved, your trade can easily close not here, but it can close much higher, right? That means that when this happens, right, because of that volatility that's been introduced, and of course, it will trigger, right, at the best available price. Now, don't forget, this happens to pending orders, right? Pending orders to enter the market and also pending orders to exit. So your pending order to exit is a take profit and a stop loss. Are you aware of that? That your stop loss and take profit are pending orders, right? If you are not, think about it. Your pending order is an order that is waiting to trigger. So your stop loss is waiting to trigger for a loss, and your take profit is also waiting to trigger for what? A profit as well. Now, if you understand that, then you now, it will ring a bell that yes, this is true. It is actually what? It is actually pending order. right? And then it can work against you as well. What if your stop loss was here? What if you were actually selling and then you wanted the trade to go down? But based on the volatility, your stop loss was here. Based on the volatility, or maybe even weekend gap, it will not close here, but it will close here. That means that in this scenario, you would actually lose more, right? If this has happened to you, I'm sure you'll be able to relate better, because when you lose more, of course, you are not happy and you want to make a complaint. But when you make more, when the opposite, the reverse is the case for the take profit, when you make more, you notice that traders won't see anything. They'll think it is an error from the broker's end and then they keep quiet. But this is not the case. So we must be aware of when slippage can occur, majorly during high impact news and even during weekend gaps. So that's why you need to be aware when this might happen. And when it's going to happen, it is best for you to what? To avoid it by not trading that period. And this is what we did yesterday with the FOMC that came out. And if you look at the FOMC, how it looked like for other currency pairs, you'll see the big candles that came out. And of course, these big candles, you know that there was serious volatility in the market. And I'm very sure if you're listening to me and you blew your account because of this, right, then you would understand better. And this is how to avoid what? Blown accounts, unnecessary blown accounts, right? So this is just a quick one to talk about slippage and of course how we can avoid unnecessary losses, how we can avoid unnecessary blown accounts in the future. So I hope this video was helpful, and if it was, don't forget to give it a thumbs up. Don't forget to subscribe. Yes, please subscribe for more videos, more educational videos that would help you to trade better, because at the end of the day, you need to understand how the market works, how the market ticks, so that you can trade better at the end of the day, right? So thank you. It has indeed been a pleasure. Do enjoy the rest of your day, and we will see you next time. Goodbye.